The Nasdaq just made a new all-time high, and many growth stocks are up 100, 120, 150% year to date. And many of you might feel like you're late on a lot of those growth stocks, but I believe there's only one of them left, and this stock has up to 100% upside within the next year. I'm not making this up. I'm going to show you the numbers and show you how this could be possible. But for some reason, anytime I talk about the growth stocks, I always get a lot of dislikes, a lot of hate. But any hated video I have always kind of ends up performing the best. Like when I told you guys about Robinhood at $47, I told you many of you will skip it whenever you see the name Robinhood. But since then, Robinhood is up 78%. Same thing with AMD. And I believe this stock is kind of like AMD, where most retail investors believe that why would you buy AMD if you could buy Nvidia, and AMD is losing to Nvidia because Nvidia is going up more than AMD. But now AMD is actually outperforming Nvidia. And I believe the same thing will happen to the stocks that I'm about to show you. It's more like a spring that's waiting to explode on really bad sentiment that's backed up by amazing fundamentals. So I'm going to show you the stock today. I hope you watch the entire video, and I hope you let me know your opinion in the comments, and I hope you enjoy it as always. And this stock is SoFi. SoFi is only up 65% since the stock went public. I believe it was in 2021. And if you compare SoFi to Robinhood this year is up 122% year to date. SoFi is up 11% year to date. And I up around 150% myself on Robinhood. But I believe next year it's likely going to be the opposite, where SoFi is up like 100% year to date, and Robinhood is up maybe 15-20% year to date. And I'm going to show you how. But most retail investors, they love comparing SoFi and Robinhood, and they believe that they cannot coexist. Like they believe it's only one company or nothing. I don't know why. You know, it's either Uber or Lyft. It's either AMD or Nvidia. It's either Robinhood or SoFi. Like the market is so big, the TAM is in trillions of dollars. Robinhood is not going to have 100% market share. Uber is not going to have 100% market share. Nvidia is not going to have 100% market share. If you look at where SoFi is involved in investing is like $1 trillion total addressable market. Home loans, student loans, personal loans, things within banking and other credit cards, lending in general. This is trillions and trillions of dollars. So there's a place for both Robinhood and SoFi to coexist, and I really don't like to compare them, but I will do a little bit of a comparison in the video, and then I'm gonna get into my valuation model and show you how this stock could double within a year on a very realistic outcome. Okay, but SoFi, as I told you, they have banking, credit card, invest, and loans. They have everything within one app. And within lending, they have personal loans, which may sound risky, but it's not. I'm going to show you why it's not risky very soon. They have student loans, which is amazing for them. And they have home loans, which has been suffering mainly due to the fluctuation in interest rates. But student loans allows SoFi to not only obtain, but retain individuals with higher income. For example, the average income of a SoFi user is between $75,000 to $150,000 a year. For a Robinhood user, it's between $40,000 a year to $80,000 a year. This is a massive, massive difference. And again, they have a little bit of a different user base or demographics. For credit score, SoFi is between 700, 745. For Robinhood, is between 650 to 700. And I believe the main difference between Robinhood users and SoFi users is that SoFi users are a little bit more conservative. They don't want to get hit with things about trading futures and trading options and putting money on betting on if the Fed's going to cut, or if oil is going up or down, or if the weather is going to change, or if whatever governor is going to win or lose. They don't want none of that noise. They just want to put money in their retirement account, leave it alone, something easy, something simple. That's why they use SoFi. If they are more active, they will use Robinhood. Even though Robinhood has been attracting different user base, but this is the typical Robinhood user. And for the SoFi Invest platform, they don't really have anything different from what Robinhood has. Even the Robinhood platform is better. But something that SoFi has that Robinhood doesn't have, which many people don't actually know about. And I just figured it out last week as I was researching on the internet. And this is that you could actually invest in private companies using the SoFi platform. If you're not an accredited investor, meaning if you don't have $1 million in net worth, or you don't make more than 200 a year, 200,000, and you want to invest in SpaceX or in XAI or any kind of company, you can invest in like an ARK fund that's only exclusively available for SoFi members. It's not an ETF. You can't buy it on Robinhood. You can't buy it anywhere else. You have to be a SoFi user for you to be able to invest in this venture ETF, and it allows you to invest in a private fund that has exposure to SpaceX, I think 15%, then like 8% is in XAI and 7% is in Neuralink and a lot of Elon Musk kind of companies and Anduril and a lot of private stuff for $500, and SoFi collects a commission. So this is, for example, something that SoFi has that Robinhood doesn't have, and SoFi is entering back into the crypto game, although I believe they're a little bit late. Now, if I look at the SoFi member base, SoFi grew members from 1.8 million members to 11 million members. This is almost a 56% CAGR. This is massive, massive growth. And Robinhood has existed for a while. But despite Robinhood existing, SoFi still grew the user base by 56%. To me, it's absolutely insane. Now, if we look at their profitability and growth, the company has been growing revenue at a rapid pace, and the growth is re-accelerating to 33% in Q1. Adjusted EBITDA is also re-accelerating, 27% margin. Is expected to be much, much higher this year in 2025. Net income is also turning profitable for the second year in a row, and net income margin is going to be around 9%. So everything has been getting better with SoFi. But to keep the video short, if you're betting on SoFi, the main bet that you're making is on SoFi transitioning from a traditional bank to an asset-light, fee-based revenue business model. And now their fee-based revenues are 41%. And I'm going to use the example of a personal loan, which many of you guys might believe that this is extremely risky for SoFi. Okay. Now let's say you go on a SoFi platform right now to apply for a personal loan. You need a personal loan. Okay. What SoFi would normally do prior to like 2022 is SoFi would hold the loan. They would take the risk of you not paying, and SoFi would be the lender because they have a banking license. They are the lender. Now it's completely different. When you go on the SoFi platform to apply for a personal loan, SoFi will no longer have to hold those loans on the balance sheet. SoFi will automatically hook you with a third-party lender that will give you the personal loan. SoFi will collect origination fees for hooking up you as a buyer to the lender or the bank. They will get origination fees, and they also get servicing fees for allowing you to pay your loan on the SoFi platform. So this way they have pretty much no credit risk. If you pay or you don't pay, they don't really get affected in any way, shape, or form. And they also collect high margin, asset-light, fee-based, recurring revenue business model. And it's very, very beautiful. And this is what's going to cause the margin explosion in the company, earnings per share explosion, which is going to start in 2026. And I'm going to show you how it's going to start. And again, the market is asleep in terms of that stuff because they're looking at SoFi, they look at Robinhood, they say SoFi is losing, Robinhood is winning. And if Robinhood is offering all those things, then why would I buy SoFi? Even though the market is so huge that both SoFi and Robinhood can coexist, which is why I am bullish on SoFi and I'm still a Robinhood shareholder. Now, if you look at the company, and this is how the CEO does it. The CEO is well known for setting low expectations for him to raise guidance. He does it. He's notorious for doing that. He's been doing it since 2023. Last year, for example, earnings per share ended up being 15 cents. He started the year at 10 cents. So earnings per share was actually 50% higher. Now, was it really a surprise? Of course not. He knew it would be 50% higher from the beginning, but he always likes to set low expectations, so he has an easier time for him to beat on those expectations, and it's better for investors, better for him, and it's easier for the market in general. Very, very smart, and him CEO actually does the same thing. But now, for example, we started 2025 with 25 cents to 27 cents. Okay, so far in Q1, he raised guidance again from 27 cents to 28 cents. We will likely end this year around 30 cents to 32 cents. Okay, now the CEO said that this year he's investing a lot of money in research and development and technological improvements that will drive massive earnings per share growth for the company over the long term. So if it wasn't for those investments, earnings per share this year would be much, much higher, but it's not going to be high because of those investments. But next year, earnings per share is expected to explode. And this is what the CEO said. He said, we remain confident in delivering 2026 earnings per share in the range of 55 cents to 80 cents per share. Moreover, we are well positioned to deliver 20 to 25% annual earnings per share growth beyond 2026. So he's guiding pretty much 100 to 200% earnings per share growth by next year. And after that, still he's expected to grow 20 to 25% in annual earnings per share growth. The current earnings per share is like 25 cents. He's expecting 55 to 80 cents. This is a massive, massive explosion in growth. And where is the stock trading at? It's trading at 53 times earnings. This is really not expensive. The company last year, they grew earnings per share like 120%. And for next year, they're expected to grow 100 to 200%. And after that, they're expected to grow around 25% here. So yes, 53 times earnings might sound expensive, but it's really not expensive at all for a company that has such long runways in terms of expanding margins in their fee-based recurring revenue business model. And with such growth, it's really not expensive at all. Okay, now this is how the stock could potentially double over the next year in just 12 months. From me looking at the CEO, looking at his track record, looking at how he always sets low expectations for him to beat, I would expect earnings per share to reach 80 cents by 2026. So I'm expecting the higher end of the range of their guidance. Although I could be wrong, but I'm using here a little bit of an optimistic case scenario, and I'm admitting that, okay? Now, if I use 80 cents of earnings per share, and I time it by 40 PE, which would be a multiple contraction, even though the company is expecting to accelerate in growth, okay? Even though margins will be higher, due to them transitioning to a fee-based revenue business model, which would warrant a multiple expansion. But I believe long-term growth of 25% earnings per share, I think around 40 PE is likely fair. I could be wrong, but I believe 40 PE should be fair for something like that. So if I time that by 40 PE, okay, I would get around $32 per share. Where is the stock trading at right now? It's up a little bit. It's trading around $17.80 per share. This is around 100% on the upside or 95% on the upside over the next year. Now, you might ask, what if it trades at 35 PE instead of 40 PE? Or what if we could make it up here, okay? Let's say it doesn't get to 80 cents, it gets to 70 cents. And it doesn't trade at 40 PE, it trades, I don't know, at 35 PE, okay? And we take the 70 cents and time it by 35 PE. This is $24 per share. The stock trading at $17. This is still like 44% on the upside in 1 year. So no matter how you look at it, the stock is extremely, extremely undervalued. And I still like it very, very much over the long term. And I think it could double in a year, which is why I have a call option on it, where if I'm right, I make 8x my money on this call option. If I'm wrong, I lose 0.5% of my portfolio. And this is how I structure those things. And I teach you those things all in my investment group. And I tell you when I buy them, when I sell them. This is the link if you're interested. But one of the risks with SoFi that you have to know is, stock-based compensation. I'm using non-GAAP metrics. GAAP metrics are a little bit worse because of stock-based compensation. And this is the thing with those growth stocks. Palantir has this problem. Hims has a problem. Snow is notorious for this problem, but as long as it's getting better over time. For example, SoFi is growing while stock-based compensation is flattening. This is an improvement. I would like to see it go down over time, which would be great, and I hope it will. But this is a massive, massive improvement, and I'm, liking what I'm seeing over here. So that was just my thesis on SoFi. This is what I think about it. I really hope you enjoyed it. Not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.